All right, friends, comrades, compatriots here on the CPA journey. Let's dive through into our wonderful introduction for all these engagement types. I refer to it a bunch of times as a menu. Think of it like a menu, right? A client comes up, says, "Oh, what do I want to order off the menu? Do I want to order a preparation, a compilation, an audit, a review, an examination?" We've got all of these alternatives. These engagement types are all alternatives to an audit. You don't need to get an audit. Now, many candidates, shout out to all my big four and massive firm friends out there and candidates studying for the exam here, right? Many of you, and myself included, when I started out at PwC, come from large firms where the only types of engagements done are audits. Now, I mean, that's not particularly the case. You've got other engagement types, but you starting out as an associate are really only going to see audits. Those are the most profitable things for those large firms, and they just throw you right on an audit, right? This makes sense for a massive company that has a large budget. So massive SEC companies. We've got public companies, the top five, Fortune 500. These large companies have large budgets, and shocker, they're also legally required to obtain an audit. So they kind of have to do it. However, for smaller companies that do not need an audit, which I've seen working at a smaller firm as well, these other engagement types are a much more affordable option, and they require less work for both individuals. Kind of like if you don't need a sports car, now it'd be fun to have a sports car, right? If you don't need to buy a $500,000 sports car, all you need is a nice Honda Civic to get you to and from work. Just get the Honda Civic. Now, it would be nice maybe to get an audit, right? To thoroughly vet everything throughout your entire company, make sure there's no fraud, nothing. But if you don't need the audit and it's just out of range budget-wise and time-wise, don't get the audit. Many times in order for a bank to give an entity a loan, the bank wants to simply see a review of the balance sheet only, right? Instead of an audit of all the financial statements, maybe they just want a review and maybe it's just of the balance sheet. So, like again, a menu, be picky. We got a lot of choices. What type of engagement do we want and how do we want specifically? As we'll see, there are significant differences between engagement types. We're going to focus mainly on these three types: preparation, compilation, review. We've got other lessons with agreed upon procedures, integrated audits, all these other types. They're all similar in the sense that they're just alternatives, right? They're different engagement types. Obviously can't cover every single one in every lesson, but I will reference to them here and there. Just want to make sure you are prepped, ready to go. We're getting ready to have a good time. Let's dive through this lesson further. Okay, first, let's just see. We've got preparation, compilation, review. A couple things here. In a preparation engagement, the CPA provides information that is used by management in the preparation of the financial statements. What I'd say here, you're kind of just acting like one of their own accountants. They're kind of hiring you to be an outsourced accountant, essentially, just doing their financial statements for them. Does not require you to express an opinion. I mean, you're the one preparing the financial statements, right? Think about it like that. You can't give an opinion. I mean, you're like, hey, my work's great, my work's wonderful. The financial statements I just prepared for you, they're the best financial statements you'll ever come across. But also, you can only give an opinion if you have a level of independence, and you're obviously not independent if you've just prepared their financial statements. In a compilation engagement, the CPA compiles the financial statements from information provided by management. Okay, so right there, you see, you're essentially just getting information from management to do the financial statements. So you're not getting any assurance over that information. You're just taking what they have at face value and putting it in there. Now, you don't need to express an opinion. So if it's completely fraudulent and there's a lot of problems with it, you're not liable. No one's coming after you because you didn't express an opinion. The purpose of this compilation engagement, we'll see kind of like what are the details of it. When you agree upon the engagement, you don't take any responsibility for the financial statements. You are just taking what management gives you and making solid financial statements out of them. Now, if these two sound familiar and similar to each other, let's kind of see what the difference is here. In a preparation engagement, the accountant is literally preparing the financial statements based on information that management provides, such as trial balances and general ledgers. However, in a compilation engagement, management prepares the financial statements and the accountant will read and help finalize the financial statements. That's kind of the difference there. Here we see that they're very similar, but here is where we make the distinction between the two types. Then lastly here, in a review engagement, the CPA reviews the financial statements and expresses an opinion on whether the financial statements are free of material misstatement. This is the closest engagement to an audit. It is one step below an audit, and we'll see lots of charts, lots of tables, wonderful graphics, comparing, contrasting all these engagement types. Want to know assurance levels needed, the amount of work needed, what types of procedures do you do during each engagement. We're going to dive into that and have a very good time doing it together. What is attestation? This is a concept. You should know it. We see that there are statements of attestation standards. So what is this term? Let's talk about it. What are attestation services? In accounting, an attestation service or engagement is the process of engaging a CPA, hey, that's us, to provide assurance or attestation audits over services such as examinations, reviews, or agreed upon procedure reports. So these are all engagements that involve attestation. You're attesting to something. Think about that term. You're attesting to something. These services can be used to gain assurance over the following subject matters. So you can have some customized agreed upon procedure, prospective financial statements, compliance, MD&A, and service organizations. You are testing, you're giving some credence to it. Non-attest services, such as preparations and compilations. So we see here, reviews have a level of you attesting to something, whereas preparations and compilations, there's no determination of independence. So you're not trying to validate anything there. However, attestation engagements require the determination of independence and many times actual independence. So we'll see there are some engagement types also where you maybe don't need to be independent, but you need to determine if you're independent and state that in the report. So I'll repeat that again. We'll see that just introducing the concept here, and then we're going to apply that to actual engagement types. For certain ones, you need to determine, are you independent? And the answer could be yes or no. It doesn't matter. You just need to disclose in your audit report if you are independent or not. Here are some items that apply to all engagement types, and we can think of them, right? It's a menu, but at the end of the day, what is everything on a menu? It's all food. It's all there to fill you up. For any engagements, an engagement letter is needed. It's just contract, right? You're agreeing with the client on what you're going to do. That makes sense because there's so many different types of engagements. You want to agree in this letter how you should proceed, what responsibility levels are assigned to each party, etc. And the practitioner needs to be able to come to an understanding with the client of the services to be performed. Totally makes sense. Doesn't even apply to accounting. If you're going to do a construction project for someone, I mean, it's a shocker if you didn't, but I would draft up a contract with that person, come to an agreement and understanding of the deadlines. So same thing applies to an accounting engagement. As such, when any level of assurance is provided, such as review engagements, which we will see have limited assurance, a signed representation letter is always critical for management. Take responsibility for the periods covered in the engagement. But when we get into those engagements where you're going to take some sort of level of responsibility, where you're providing limited assurance, or you're providing some sort of assurance, you want to make sure you're distinguishing who has responsibility for what. Let's get that blame away from us, right? We don't want to take responsibility for anything we don't want to. If this letter is not provided, the practitioner should withdraw from the engagement, right? Disclaim the opinion, get out of there, just head for the hills. Additionally, the first step in any engagement is that the accountant should obtain a general understanding of the client's organization, operational structure, and its business. So again, these are items that apply to any engagement type. You're going to do this in any engagement. Now, varying levels, I'll say, just a little caveat there. If you've got a compilation or a preparation and it's not essentially a heavy engagement, you may not do this to that much of an extent, right? You may just piece together all of the information, the reports together to create financial statements. It just depends on the severity of it and how much work you're actually going to do. Now, when changing engagement types, the reason for the change must be legitimate. Like we said, we have a menu, and well, you're entitled to, if you get to the waiter quick enough, you can say, hey, waiter, I actually ordered the filet mignon. Well, good for you, fancy steak over here. I'm feeling actually, let's go carb heavy today. I want to change to the penne alla vodka, right? We want to get some pasta. So if that's the case, now you can do whatever you want. In a restaurant, you're being serviced there. But when we're changing engagement types in the accounting world, it needs to be a legitimate reason for a change. You can't just say, yeah, we're getting an audit. Oh, wait, no, we want a review now. There's a big deal with that because the restaurant serving you a different meal doesn't really affect them at all. Maybe financially they're making a few extra dollars on you, but there's no legal responsibility. With these engagement types, you have a level of responsibility. So you need to say, oh, hold up, as the auditor and as the client, you take a step back. Let's assess what's the reason for the change, because that's also going to change the level of responsibility, the need for an opinion, the level of independence required. That's going to change a lot. So you need to take a step back and think about it. One big concern I'll talk about here, let's talk about an audit. So if a bank says you need an audit, okay, cool, right? But then if the bank says, we actually don't need you to get an audit, you can get a review, that's a legitimate change because the main reason for you getting an audit was the bank, a third party telling you want a full audit, but then the bank decided to change it. One illegitimate reason would be if, let's say, the someone in the client engages you to do an audit, and then one of the managers is like, "Oh, wait, actually, if they audit us, they're going to discover some fraud. So let's actually change it from an audit to a review because a review is less in scope than an audit. And maybe if they do a review, they won't detect any issues in the financial statements." Now, that's a classic example of a illegitimate reason to change the engagement type, and that would be a problem. And that's what you as the auditor should assess. You should assess what's the reason, and you obviously want to document that reason, make it known why we changed the engagement type. Now, the change in engagement type could happen in the beginning before you do any work, or maybe it happens in the middle. We can talk about that more. We've got that on later slides. We actually talk about that in other lessons as well. So just kind of feeding that seed in your mind, right? Thinking about this sort of concept. It's a menu. You change your mind. That does happen. Now, obviously, as I mentioned earlier, we've got clients that are massive companies and are legally required to get an audit, and that's not really an option for them. But let's think about this like you've got a 200-person firm. You're dealing with decent-sized businesses. You've got a business that has 12 franchise locations for a restaurant. You've got a manufacturing business that makes $100 million in revenue a year. So you got business of that size is kind of, this applies to many other business types. I'm just trying to paint that idea in your head, kind of, put yourself in the shoes of that. Because, like I said, a lot of you, they're probably working for massive companies, massive firms. Take it down. Have a good time. I've seen a lot in the accounting world. Maybe you are happy where you are and you don't want to see a lot of the accounting world. That's totally fine. Scope limitations put on the practitioner are not legitimate reasons for a change, such as you don't want them to do an audit because they may discover your fraud. And in that case, the accountant should withdraw from the engagement. So if you now, they're not going to say, "Hey, accountant, don't do an audit for us because you're going to discover fraud." But use your professional judgment. If you don't see a real reason for the change of engagement, you should just get out of there. Generally, in the final report of the new engagement type, the accountant should not mention the previous engagement. That's important because you don't want to confuse the readers of the financial statements or the readers of the report as to what happened. You want to make it, okay, this was an audit. Now, there's a lot less issues for bumping up an engagement, let's say from a review, which is less in scope than an audit, so it's less work, to an audit. I mean, obviously, you still want to assess there and you want to think about it for a second and say, okay, can we actually do this audit? Do we have enough manpower for it? Do we have the budget? Do we have the time? Do we have the knowledge to do the audit? That's something to assess, but there's not a concern of, that possible fraud issue. When changing engagement types, the accountant should reassess engagement acceptance and if there's any issue in the change. So it's kind of like, if you hit this point, go back to the lesson on engagement acceptance. That's what I'd say there. Reassess everything we talked about there. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.